We are studying learning unit number 7, right? Of the study guide, it will be, oh, by the way, study guide will say page 1, but if you are using the online version or the PDF, it will be somewhere in the 112 page 112. Please locate to study guide and learning number 7. The study guide will say page 1. However,
Okay.
when you check at the top, you see the PDF will have that thing at the top. Let me show you where I'm referring to. The PDF will say page 112. You see the PDF. When you open from the PDF, it will show like this. Do you see this part?
Well,
But
yeah, I see
however,
that.
it's marked as page 1, but on the PDF thing, it will be, it's like page 112. So normally here we'll be dealing with the situation whereby the company, these two companies that we are doing, these two companies that we are busy with, the one which they are doing the consolidation, now they are trying to sell each other's things. It's either they sell the assets, it's either they sell inventory, it's either they do the loans. So those things, it's either they do the bill of exchange. So those things, we have to eliminate them. So the main purpose of this study unit is to show how to eliminate those intra-group transactions. That's why it's called, if you can see, elimination of intra-group transaction. That's the main topic of this thingy, of this study unit, which will be dealing with more in extent of that elimination that we used to do it in the prior examples. So 7.1 introduction. In the presiding learning unit, we introduce you to the basic consolidation process for the wholly and partly owned subsidiary. In this learning unit, we deal mainly with the other intergroup transactions that take place in groups and therefore have to be eliminated for consolidation purposes. We deal with trading inventories as well as the property, plant, and equipment held in the group. So in this case, we'll be selling the inventory and also selling the property, plant. So it will be in both ways. It's either can be sold by a parent selling to subsidiary or subsidiary selling to the parent. And then there will also be a situation where they will be doing the revaluations. We would like to emphasize that we do not deal with the taxation or unrealized intra-group profits or losses. So those one to be part of the FAC in the third level. So 7.2, the intra-group bills of exchange and bank overdraft. A bill of exchange is a negotiable document. It's a written instruction directed by one person to another, instructing the person to pay upon demand a certain sum of money to the person nominated in the bill of exchange. So for example, we've got bill number 111, which happened on the 30th of October 2008. It was directed to Mr. P Limited for the 2000, and then you have to pay amount of 2000 to S Limited on 30 November 2008. So S Limited, which is a subsidiary, will treat it as a bill receivable in his records, while P Limited will show as a bill payable. So upon consolidation, the subsidiary bill receivable will be offset against the bill payable in P Limited records. From a group perspective, the group can not enter into a transaction with itself. S Limited could have converted the bill into cash before 30/11/2008 by selling it to the financial institution. This type of transaction is known as a discounting. On consolidation, we may only offset the bank overdraft of one company in the group against the favorable bank balance of another company in if both companies have their account at the same bank and the company with the favorable balance has guaranteed the overdraft of the other company, or the bank itself will offset the two amounts against each other in terms of agreement between the two companies and the bank. So in case where the company A is a parent, company B is a subsidiary, and subsidiary is having a overdraft, and the parent is having the favorable balance. So they can be offset against each other independent of the company. But that while it will be based on the agreement of the bank and together with the company. So 7.3 is the revaluation of property, plant, and equipment. So they say the asset of the subsidiary could be revalued at the date of acquisition at the interest if the carrying amount and the market value of the asset differ. 1, there will be the following institution which they may arise. 1, subsidiary asset may be revalued merely for the purpose of determining the purchase price without a journal entry being made in the subsidiary financial records. the assets of the subsidiary may be revalued in order to determine the purchase price, and adjustment is subsequently made in the subsidiary financial records. Know that the revaluation of an asset may lead to capital gain tax, which is ignored for the purpose of this module. We will use the following two examples to explain the two situations. Let's see example 1. Example 1, we've got A Limited acquired 80,000 shares in B Limited on 1 July 2001. Each share carries 1 vote. At that date, the land belonged to B Limited was revalued or was valued at 200,000. No adjustment was made in the financial records of B Limited. The retained earnings was 46,000. At 30 June 2004, the trial balance of A Limited and B Limited were as follows: credits, share capital, ordinary shares, retained earnings, long-term borrowings, C Limited and A Limited, and then current liabilities. Then on the debit, landed cost, investment, loan to B Limited, then current asset. So you see there was loan B Limited on the debit, and on the credit there was loan A Limited. So additionally, information: consider the carry amount of the assets and the liabilities of B Limited to equal to the fair value thereof at the date of acquisition. Required, you have to draft the financial statement, the statement of financial position of the A Limited group as at 30 June 2004 in compliance with IFRS. So when you draft this, you know it's gonna do the normal things that we used to do. So we're gonna follow the basic principle of our doing consolidation. Please remind me. I want to check if you mastered them. What is the first one?
We determine the percentage of the shares first, and then we do analysis of owner's equity.
Analysis of shares holders. Number 3.
Pro forma consolidated journal entry.
Which is for elimination purposes, right? And then from there we consolidate. Then 4, we consolidate. So let's see with example 1. So now we have a situation whereby we determine the percentage. This thing's not typing. Determination percentage. So this guy acquired how much shares? He acquired the subsidiary issued 100,000 ordinary shares. He acquired, we don't know how many shares he acquired. Let's see. The investment consists of 164,000 ordinary shares. So how many? Okay, we have to, how many shares are in value? It's 300 by 100 by 100, 300 by 300, and then we have the investment limited favor is 164. Okay, they acquired 80,000 shares. You see at the top of the question. Do you see it? Which the shares in B Limited, they were 100,000. So it means it's gonna be 80%. So we are happy, right? Then 2, we're gonna do analysis. Analysis of shareholders. So the analysis of shareholders will be, we start with the total, then we have the since acquisition, which it can be at, and then we have since, and then we have the non-controlling interest, which is called NCI. So here is at 100. Here it will be at 80. And then here it will be at 20. Then the total share capital for subsidiary is how much?
100,000.
And the 100,000. Then when we do the percentage at acquisition, it will be 80,000. And then on the non-controlling, it will be 20,000. We are happy. So there was a retained earnings on the date of acquisition. It also shown on the top. The retained earnings, it was sitting at 46,000. 46,000. Then the percentage of 46, 80% with 36,800. And then the 20% of it will be 9,200. Then now from the information given, they said the land belonged to B Limited was valued at 200,000. So now question is how much, if the land was valued 200,000 before it became 200,000, how much was this land? You see on the pre-adjustment trial balance, they show the land at cost price is 140,000. Do we see it?
Yes, sir.
So it means we're gonna say the market value which the land is costing now, which is valued at 200,000, then we less the 140 that was the cost price. So it means the revaluation that we have done is for 60,000. Then the at acquisition, the 60,000, 80% of it will be 48, and then the remaining will be 12. Then we do our total. And then we check how much did this guy purchase. They said the investment that was done by this guy on the pre-adjustment trial balance. There's investment in B Limited is 164. So investment So it means there is no goodwill. It's 164. So 164, 800. So this less this, it means it's nil. There is no goodwill here. Goodwill or purchase difference.
Can I ask,
Mm-hmm.
is it possible for them to say the current amount of entities are not equal to the fair value?
The current amount is what?
They're
I
not
can't hear
equal
you
to the fair
properly.
value. The current
The
amount
current,
of all the assets and liabilities, they're not equal to the fair value. I'm saying, is it possible for them to ask that the current amount of asset and liabilities, they are not equal to fair value?
so you are referring to the
current
statement. Yeah, I
liabilities
get you.
and
I
asset,
get you. I get
the
you.
current amount of the carrying amount of liabilities and asset are not equal. Okay.
No, it's not. It's not.
Is it
It's not,
possible for them to?
no. It will always be
Okay.
like that.
Okay, thanks.
Okay. So now we have a goodwill of 0. Then from after the goodwill of 0, it just means we can proceed further and see what other things involved us. So the acquisition was made on which day? Was acquired on 1 July 2001. So July 2001 to 30 June 2002 is the first year of acquisition. So from 30 June 2002 to 2004, it can be the other years. However, on the prior years, we don't see any retained earnings of the prior years. We only see the retainings of the current. So there's no need for us to do that thing of since acquisition to the beginning of the current year, because they acquired on the day they acquired. So we had the retained earnings. From the day they acquired until end of the year, there was no any other retained earnings except the one which is shown at the end of the year. So we can just say here since acquisition to the end of current year. So the since acquisition to the beginning of current year, it will only come if there was a retained earnings of last year. Since acquisition to the beginning of current year. So we're gonna have the retained earnings. The retained earnings realized, it was the retained earnings at the end of the financial year, which is shown in the pre-adjustment trial balance. The retained earnings was shown as 92,000. Do you see from the pre-adjustment trial balance? Minus the retained earnings at acquisition, the date we acquire, whereby the retained earnings was 46,000. So we don't have any profit realized. So we're gonna say 92 minus thingy, 46. Then we say since acquisition, it will be the percentage of by 80%, and then that side will be 20%. Then we can close off our thingy. I guess up to so far, no question. It was just a straight thingy. Then we're gonna do the third part, elimination. Which we called a pro forma journal. So our elimination journal, it will have the debit, it will have the credit, so we eliminate those the things that happen at the beginning during the time when we do the consolidation. So we revalued land. You remember we revalued land. So we say the land, normally the revaluation surplus will go on the debit, the land credit, because the revaluation is based on the revaluation surplus. So now check the before. This revaluation happened on the revaluation at that day, the land belonged to Billy was revalued. We see the revaluation, it happened, but it was not done in the books. Do you see that statement? Do you see the statement?
Yes, sir.
Yes.
Okay, so it means we have to account for that thing first. We have to account that journal first. So before we do the elimination, we're going to record the journal whereby we're recording is a normal recording, this one, in the books of B Limited. Normal recording in B Ltd books. So here we are recording the revaluation which happened, but it was not recorded. So normally, the let increase on which side? Increase on the debit side, right? So we're gonna say on the debit, we say land. And then on the credit, revaluation surplus. So it's important to note those things if they say it was not taken, so that you can take into account. We are happy, right? Are we happy? Okay. Then from there, we do the elimination journal now. After we recorded that thingy, now we have to eliminate whatever needs to be eliminated. So elimination journal again, we know to always be debit, credit. Then we say, now we're going to eliminate these things that happen at acquisition. So at acquisition, there was a share capital that need to be taken out. Share capital increase on the credit side, but now because we're eliminating it, we debit it. The share capital we're going to eliminate will be 100,000. Then we eliminate that retained earnings. Of how much? 46. Then we have to eliminate again the revaluation that happened, which is this revaluation that we recorded, because now it was land increasing on the debit. Now we have to do the reversal. So you see our revaluation surplus was on the credit. Now, since you are reversing it, it's going to be on the debit. The revaluation surplus, 60,000. Then we don't have a goodwill to be recognized. Then the investment that was happened, it was for how much? We invested by 164,800. So when you add this, they give us 206, but this one side is 164. So it means there is something missing. So if you say this side minus this side, we are left with an amount of non-controlling interest of 41,200, which is the one that was shown here. This one. Non-controlling. Which is going to go to the SFP. We are all happy. So on the journal, they just do another extended column. They just call it NCI. So which is they mostly based on whatever happening on this call on this side. So we're gonna take that for 200 to also put it here. So this is it will be made for the SPL side. So let's proceed. So up to so far we are happy, right? We eliminated the acquisition of that owner's equity. That was the main purpose of this journal. We are happy, right?
Yes, sir.
Okay. Now we're gonna go to the second columns or the second journals. Now there was a journal in B Limited for the retained earnings. So that retained earnings, remember, we took here. This part is eliminated, fine, during the date of acquisition. But this part, whatever happening on this side, up to here, like this, on the analysis of shareholders, whatever happening on this side, like on the bottom side, it will form part of the group. But whatever is here, it will be for the outsiders. So now we take the things for the outsiders. We say, okay, on the outsiders, what do we have? On the outside, we have a retained earnings because this one is going to form part of our retained earnings at the end of the year. So we say on the outside that we have a retained earnings. So normally the retained earnings increase on the credit side, but because we are eliminating it, we'll put it on the debit side. From the outsider, the retained earnings that we have to debit is 9.2, which is this one. So the retained earning will be contra account for it. It will be what? The non-controlling interest. Then it means that is also eliminated. We are done with it. Then we say the record, it will be record of non-controlling interest on the date. That will be narration. In B Limited for period 1 July to 30 June. Then there was the, if you can check on the pre-adjustment trial balance, There was this 80,000 loan, loan receivable, loan payable. So on the debit, on the credit, we've got long-term borrowings. We borrowed 80,000 from A Limited, and then on the B Limited side, he paid like he gave the money to B for 80,000. So since since A Limited was the one who received the money, now you have to reverse it. So it means on the debit side, we're gonna have a loan and B Limited because we are reversing it. Loan A Limited. Yes. So journal, now we're gonna say loan A Limited. So A Limited
Excuse
will.
me, sir.
Mm-hmm.
Do we always have to put narrations?
It depends. If they tell you that narration are required, then you have to put them. If they say they don't want them, then it's fine. Don't put them.
Okay.
But in most
Thank
cases,
you, sir.
narration, they are good to put them because they will. It's like show you the understanding of why are you doing that journal. What was the purpose of you doing that journal? So even if you don't write them in your script, but at least if you can have it on your own. Okay, my main purpose of this journal was to do A, B, C, D, E. Then you narrate on your side. You can narrate on your heart or on your mind, even though you don't write it on the script. I don't know if you get me. Suppose they say narration are not required. But if they
Yes,
say
sir, I understand.
narration are required, then it means you have to write it. So me, I prefer a person to know the narrations so that you know the reason why you are doing that journal.
Okay. Thank you, sir.
Okay. So on the journal, we can also have a loan B Limited. So loan on the credit side, A Limited is the one who acquired the loan from B. So since he acquired it, now he have to reverse it. So when he reversed the loan normally increases on what? On the credit side, but because now you are reversing it, you have to reverse it on the debit side. So does it make sense? My line 56. Are we happy with this journal? We happy? Silence means consent. Then we go to another journal if there is any. We don't have any bills payables. So it means we are done. So this will be the elimination of intra-group loan. Because this one got loan from the another one. So now we can do the consolidation of the remaining things. Whatever which was not eliminated can be consolidated. So we're gonna state they say we must have the same financial position. Financial position for the year 30 June 2004. So we're gonna have the assets, which will come as a non-current asset, which will be the PPE. So a PPE, it will be the land and the buildings plus other things. The land at cost, we're gonna have now the 250 plus the land acquired for the other guy is how much after the revaluation?
100,000, sir.
100,000. Remember, our PPE will, let's do it aside. We're gonna have land like this. Land, the one for parent is how much? Parent land is how much? From the pre-adjustment trial balance is 250, ne?
Yes, sir.
And then the land for subsidiary, it will be, remember it was now revalued, ne? From 140 to 200, ne? So we're gonna say 200, 1, 2, 3 times, okay, times 80%, which is it's 160, right?
Yes, sir.
Then
160.
we add it with 250. It gives us 250 plus 160. Give me 410. Then there's something that I don't follow though. Because if they take the land of B Limited valued at 200,000 without it's because of that elimination journal. Okay. So now we're gonna take, yeah, now I get it. So it will be the one for subsidiary to be straight as 200,000 because the elimination done was taken away. So the 200 and the thingy will be 450.
Sir, so we won't take 140 into account for B Ltd.
The BL, because I want yes, and the reason being this was revalued on 1 July, né? So when it
Yes,
when it was revalued on 1 July, the 140 was taken on 1 July for the financial year ended 30 June 2002. They took 140 into account. But there was a subsequent financial year, because remember, we are doing the 2004 financial year. For the subsequent year, now we're going to take the 200.
Oh, okay.
It makes sense. So if you
Yes,
were
sir.
doing on the same year that it was revalued, we were going to only take 140. But because we are doing all the subsequent year, where by now it's valued as 200, and no any other information is happening on it, then we can avail it at 200,000.
Okay. Thank you, sir.
All right. Any question on the land part? Then we proceed. So the land is 450. So do we have any other non-current asset except the land? I don't see it. So it means our PPE will remain as 450. Then we go to the loans are eliminated. Then we can go to the current assets. There's someone, I don't know if he's doing washing or something, but I hear a sound of a machine. the current assets. And see, thank you. Current assets. Our current assets, we have 81,000. Well, that's 198. So it's how much? Let me calculate.
279,200, sir.
279,200. Thank you. Then that will be our current assets. So it means our total assets will be represented by 450 plus 279,200, which is 450 plus 279.
279,200.
So you got 729, right?
Yes.
I was not sure. I was like, it seems like it's a big value. Okay, then we go to the equities. On the equities and the liabilities, we're gonna have equities. Share capital, we only focus on the one for parent. The share capital for parent is how much?
300,000.
300,000. And then the retained earnings for parent. So this one, it will be for parent. And then we also have to take into account the one of a subsidiary. So the retained earnings of a parent is how much?
121,000.
This 121,000. Then we add it with what? The one for subsidiary, we're gonna take this. We're gonna take this one because here is at 80%. You get it, ne? So please don't confuse this. Don't say why are we taking the 36,800 here, but we didn't take the difference of the revaluation because the revaluation was eliminated. So now since the revaluation was eliminated, we only take the value of the land itself, not because remember the land was not eliminated. We only eliminated the revaluation. You get it? And see? And see? Am I still audible?
Yes, sir.
Okay.
Yes, sir, we can still hear you.
Oh, because I'm no longer hearing the reply. I'm saying maybe the network is performing. Okay, then we proceed. 121 plus the 36,800, which is the one, this one. I'm gonna add it here. Then we have how much? We have 157,800.
Yes, sir.
Then we'll proceed. We're gonna go to Since this will represent our total equity before the non-controlling, so we have to add the non-controlling interest, the one which they come to the SFP. Controlling interest, which is how much? The non-controlling interest that have to be taken into the SFP will be this one. Remember, when we do our thingy, we have to add this also. Then when we do our totals, there should be totals, which I didn't include them. Let me do them here. That, oh, sorry, I'm on the wrong side. That. So here, no fail. So here we're supposed to have the totals. Which they were gonna be like, when you take this further, this is 9,200. I put the wrong thing, 9,200. So when you take this further, it will be this. Then there will be 50. Some this, they give you 5,400. So the 5,400, you must take it to here as you are non-controlling. So the 5,400, this one is transferred here. We all happy?
Yes, sir, we are happy.
Now we proceed to our liabilities. On the liabilities, we're gonna have non-current liabilities. So remember the loan from A to B, they were gone. So we're no longer gonna include them. We're gonna only include that loan which was taken by, I think it was taken by A Limited. Is A? Yes. A Limited took a loan from C. So you see, there's a long-term borrowing C Limited. So we're gonna take that one. So it will only be 140. And then we proceed further. We're gonna go to the current liabilities. So on the current liabilities, our current liabilities will be for the parent is how much?
It's 15,000.
And then we add the one for subsidiary of 66,000. Then we have the total of 81. Yes, 81,000.
Yes, sir.
Then we can balance our thingies. When we add this together, they give us 729,200. We have 729,200. So we are happy with our total equities. Equities and liabilities. We are happy.
Yes, sir, we are.
Okay. Anyone who want to ask a question up to so far? Any question? So we are all fine. Okay.
Yes, we are okay.
So now I think the next unit there will be the next example. If it's example 2 and not having any issues, I'm not gonna do it. let's see, the example 2, P acquired 70% interest share carry 1 over which debt acquisition, land and building was valued 200. It was 200, now valued to 300. It means gonna have a valuation of 100,000. The company proceeds to value the land belonging to S Limited every second year. On 31 August, at the date of question, the retained earnings was this 20,000. Then they have the pre-adjustment trial balance. And then from here on, they did the consolidation. So I just want to check what was the complex thing, if there's any. The valuation 200,000, 170 per difference, retained earnings. Okay. So here is just only the matter of a date, whereby they said the reversion was happening after every 2 years. So you check when was the acquisition date versus when are you preparing the financial year. So you find that I think there were almost 4 financial year whereby the thing was supposed to be revalued again. So it was revalued twice on our basis of completing our financials. So they acquired this on 1 May 2002, and we are doing the books for 2006. So 2002 to 2003 to 24, and then 24 to 2006 again, it will be revalued. Yeah. So example 2, I will jump. Let me see example 3. Yeah. Now I'm gonna start on the paragraph 7.4. So we can page 2. It can be page 122. It can be page 11. So I don't know on your side it will be what page, but one of the two. So while I'm checking something here, what I want, 10, 7, 2, 8. Yeah. So now we'll be dealing with the elimination of the, as we already started on this start unit 7. So now we've done the issue of the smaller item, like the one of the loans versus the bills payables. Now we are going to the situation whereby we are eliminating the assets, for example, whereby the subsidiary is selling to the parent or the parent is selling to the subsidiary. So now let's read. They say, as mentioned previously, the purpose of consolidated annual financial statement is to offer annual financial statement after the elimination of all intergroup transactions. We should eliminate those profits or losses or transaction within the group, as the group is regarded as one economic entity and will not enter into transaction with itself. P Limited sold to S Limited. So S Limited sold to X. So whatever profit which will be realized by S Limited when he's selling to S, I mean, the profit realized by S Limited when it's selling to X, it must be taken out because it will be the profit outside the group. So let's see. Suppose P Limited selling inventory to S Limited at the cost of 1,000 plus 20% profit. That's P. And then S Limited takes the inventory and sell them to X, a company outside the group, for 1.5. So that profit of 1.2, the one which was realized by P Limited, it must be taken out. But the profit realized by S to X, it will remain in the books of S because it's for outsiders. So let's see now. The following situation may arise from this scenario. All the inventory have been sold to X Limited at the end of the financial year. There will be no change to the consolidated annual financial statement of as the profit is actually realized by selling it to the company outside the group. But if no inventories have been sold to X, we should eliminate the unrealized profit of 200, the 20% times 1,000, as the profit had not yet realized outside the group. The inventory of S Limited and P Limited profit include this amount. To eliminate the unrealized profit, S Limited has to subtract the 200 from its closing inventory, i.e. inventory should be credited, where the P Limited has to decrease its profit by debiting cost of sale with 200. If half the inventory has been sold outside the group, 100 should be eliminated. So here, the elimination is only focusing or is only done when we are doing things that they were not sold. So here, I don't know how I'm gonna present because I want to show the slide. I also want to show the Excel. So it will be going up and down. So elimination of inventory or of profit realized, of profit from inventory. So we only eliminate unrealized profit. So it's like we eliminate the profit from closing inventory. As such, inventory was not sold. So here, guys, I want you to listen very attentively. Now is where this module is starting. So based on the example that we had, the one of P, S, and X, P is the parent. He sold inventory to S. Whereas sold inventory to X. So we were given that the inventory that was sold to P sold inventory to X at 100 plus. So the selling of P, it was 1,200. But the inventory costed 1,000. Then that is on P selling. Selling to S Ltd. Now, S sold inventory by 1,500 to and his inventory now was costing 1.2. Inventory costed 1,200. So this side is whereas selling to X Ltd. Now X sold inventory to S limited, take the limited and sell to X limited, and X sold to outside at 1.5. Now, okay, am I doing things right here? Here we've got P, he sold the inventory by 1.2, and then S sold the inventory to X by 1.5. So now selling inventory to outsiders. For how much? Nobody knows. So now let's account this thing. So they were told that if this inventory of 1.2, which was sold to S Limited, and S Limited managed to sell it, all of it, there is no elimination that's gonna happen. If inventory acquired by S acquired by X and by S. If inventory acquired by S was sold all of it, no unrealized profit will take place. No unrealized profit will take place. But if the inventory is not sold, then there will be unrealized profit. We will have unrealized profit, which need to be eliminated. So the elimination is only happening on the inventory that was not sold. So let's continue reading. If no inventories have been sold to X Limited, so suppose S Limited didn't sell any inventory to X, so it means there was going to be elimination of that unrealized. As the profit has not yet realized outside the group, the inventory of S Limited and the profit will include this amount. So to eliminate the unrealized profit, S has to subtract the 200 from its closed inventory, i.e. the inventory should be credited. If half the inventory has been sold outside the group, 100 should be eliminated. So a very important aspect of consolidation is that we must start by determining which company is selling the inventory and which company is buying them. So you see here on the page, it can say page 12, it can say page 123. We've got parent sells to subsidiary. So if parent is selling to subsidiary and parent is making the profit, no adjustment to non-controlling interest is necessary. Then if subsidiary sells to parent and subsidiary is making a profit, so the non-controlling interest must be adjusted by its percentage interest in profit. This adjustment made in the analysis of the owner's equity. Note, unrealized profit and losses have income tax implication, but we will not deal with the income tax complication this slide up to so far. So let's have example 3. On example 3, we've got parent selling inventory to subsidiary. The following is a trial balance of A Limited and its subsidiary B Limited at 31 December 2008. Share capital is 200 and 100, retain earnings 120 and 80, profit before tax 80 and 60, investment 80, and then a PPE 200, inventories 50 and 30, 3 other receivables 70, 50, 3 other payables 30, 60, taxation 30, 20. Additional information. A Limited acquires interest in B Limited at the time of the incorporation of B Limited. B Limited purchased all its inventory from A Limited at cost plus. Now listen, B Limited, which is subsidiary, purchased inventory from A Limited at cost plus 25%. So that inventory we see, the one for 30,000 in B Limited, it was purchased at cost plus 25%. The inventory on B Limited's financial records amounted to 20,000 at 1 January 2008. So that was the opening balance. The opening balance was 20,000. The closing balance is 30,000. So there was purchase happened during the year. A Limited total sales to B Limited during 2008 amount to 100,000. So in total, A Limited sold inventory to the value of 100,000 to B Limited. So required, draft the consolidated annual financial statement of the A Limited group for the year ended 31 December 2008. So nothing changed. We're still going to do our basis of consolidation as normal. So up to so far, are we clear with this things of whoever is selling to whoever, and then something need to be eliminated?
Yes, sir.
Okay. I wanna check something. Hold on. I think I'm still having issues whereby okay. Parent is selling to subsidiary. So I'm gonna share this little bit. You just have a look. You can write if you are writing, it's fine. Maybe I can give you 1 minute or two to write. Tell me if you can see it. Can you see this PowerPoint? Can you see it?
Yes, sir, we can see it.
Okay. If it's possible, you can write this thing.
Yes.
I will give you just 2 minutes to write. Now we are dealing with a situation where parent sells inventory to subsidiary. So the movement of inventory will not affect analysis of shareholders. As analysts, we focus on subsidiary part, and the NCI will have on consolidated statements. So the unrealized profit will be eliminated from inventory as well as the retained earning on the statement of changes in equity. So because more we are saying parent is selling, so the profit that was not realized, it will only be on the parent part, but because we are only focusing on the consolidation. Remember, the parents only show things when we are doing the consolidations. It doesn't have any effect on the analysis of shareholders. So it means in our case, that unrealized profit, we're not going to show it anywhere in the analysis of shareholders because in this case, the parent is selling to subsidiary. The movement will only happen on the NCI as well as on the retained earnings on the statement of equity. The parent selling to subsidiary. Then from there, we'll continue on the study guide. So are you still writing, right?
Yes.
Okay. I will also gonna upload this thing to Grigory, so Grigory can publish them on my NISA, so you'll able to get them at a later stage. So I think when they will be sharing the recordings, they can also share these PowerPoints together with the exercises from the class, the one we are doing on the Excel sheet. Yeah. Okay, then now I'm giving extra 30 seconds for those who didn't finish writing that statement. Can I proceed? Okay, so let's start. Here is parent selling to subsidiary. Subsidiary. So I'm gonna share Excel now. I'm sharing Excel. You can see my Excel. You can see it?
Yes, sir, we can.
All right. So that example, which is on example, it's example 3, right?
Yes, it's example 3, sir.
Okay. So now we're gonna start with the analysis. So on the analysis, there won't be much movement happening. Analysis of shareholders. No movement will be happening that much because here the inventory is from the parent ceiling. So the only profit that is not realized, it will be on the parent side. So it will be shown when you are doing statement of profit and loss and the same change in equity. So we're gonna have a total. We're gonna have the add part. We're gonna have the scenes. We're gonna have the NCI. So the percentage is already 80%. I didn't want to determine it, but they tell us 80%. So here's 100, 80, 20. So I'm gonna just try to be faster because my main reason I want to show that thing of unrealized profit. So on the analysis, even if I just take things straight from the solution, don't get worried because remember you already know how to do the things from analysis. Is it fair?
Yeah.
Is it fair?
Yes, sir.
Yeah, because like if I try to show anything again on the analysis, then we might end up not getting into our elimination part. So we're gonna just write the way things they are. We've got share capital, which they say 100, and then is is 80,000, and then we have 20,000, and then we have purchase difference. So I'm not gonna explain anything. It's like I'm just copying the solution the way it is. Because my assumption is that we already know what's happening here. Consideration 100, 180, 20.
Okay.
Then we go to since acquisition. Since acquisition, we have to beginning. BGN mean beginning, don't be confused. BGN mean beginning to the beginning of current year, which is 80, 64, and then 16. And then we have profit for the year. So the profit for the year realized for subsidiary on the, if you check, this is the one which can confuse a little bit. If we check on the profit before tax, it was 60,000, and then that was at the end of the year. Before that, it was sitting. That's what. S40. You see, the 60 is profit before tax. The 60 minus 20, then it will give you the 40,000, which will be the net profit. So the net profit of 40,000. Do you see what I'm referring to? When they say profit for that is 60 minus 20, The 60 is profit before tax. The 20 is taxation. We are happy. If you check your pre-adjustment trial balance, the 60 is profit before tax. The 20 is the taxation. So they give you a profit of 20,000. We are happy, right?
Yes, sir, we understand.
All right. I'm sorry, here's 41. Then 32. And then come on, it will be 8,000. So we can do the totals of this. Because I just want to rush to that tricky part. That's why I just do things quickly here. 220. And then we have 96. We have 44. Now we're gonna start things. Now we have to present there will be elimination journals. So it's where things started now. Elimination. So on the elimination part, I will also run faster, especially on the item that we used to know, like the share capital goodwill investment. I will run fast. The retained earnings and the non-controlling is the one that you know. I'm gonna also run fast. The non-controlling SCI, the non-controlling SFP, I will show where do you get those things together with the elimination of the intra-group sales. So elimination journal. It will be debit, credit, credit. So we have a share capital. Share capital of on the debit side 100, and then goodwill is 0. Of 0. Then investment in B. Investment in B Ltd. Investment in B Ltd is 80. Then the non-controlling thingy. Non-controlling is 20,000. Elimination of honest equity, that's the narration. And then we go to the retained earnings. The retained earnings is the one that is shown here. It will be this one. So we're gonna put it here as 16,000. So it's being eliminated by the non-controlling interest. Non-controlling interest of 16. Then now I show you what I wanted to. The NCI, the non-controlling SFP, the non-controlling SCI. Non-controlling SCI, it will be this. So it's the one that's gonna be plugged here. $8,000 and 8,000. So remember, in most cases, the S in the statement of financial position, we credit in most cases. So the non-controlling it's gonna be credited on the statement of financial position, and it will be debited on the statement of change in equity, or on the statement of changes in other comprehensive income. Non-controlling SFP. I think we are still fine up to so far. Anyone have issues?
No, sir, we are still fine.
Okay, let me proceed further. Now, there was this adjustment, or it was a statement whereby they were saying adjustment number 3, A limited total sales to B limited 2008 amount to 100,000. So it means sales GR. So in the books of A Ltd, he had sales in the credit side, right? He had sales of how much? 100,000. While B limited he had B limited had inventory or purchases. He had inventory of how much? 100,000. We are all happy here with these individual ledgers. We are happy.
Yes, sir.
It's only one person responding. What about others? Mwalengwe. Okay, Mwalengwe say okay. Tulane, Ready, Noiso, and Langlev.
Yes, sir. It's Rabi here.
Okay. Now, when you talk, I can see when you talk is fine. Okay. So now we want to eliminate this thing that happened. So on the A limited, it was credited, right? You see, on his book alone. So now, because we are taking it off, we will say sales A limited, A Ltd. We put it on the debit of 100,000. And then on the credit, we put, remember the inventory is gonna use as a cost of sale because B limited, this inventory will end up selling it, right? So the cost of sale B limited is also 100,000. So this is the elimination of these things. We are all fine.
Yes, sir, we are.
Yes, sir.
Now let's proceed. Now we can go to the statement of changes. Sorry, the statement of profit and loss. So the statement of profit and loss is where now it's going to be complicated because remember, as per the information I show, I said it's going to affect what? The statement of change in equity, the retained earnings. And remember, anything that affects the retained earnings, it means it comes from the statement of profit and loss. Ne? So now we do the statement of profit and loss. Statement profit and loss. So on the statement of profit and loss, let me check up. I still have the previous notes. Back PC. FAC2602. That's what. 2 minutes. Just want to check something. Access 118. Okay. I want to present a little thing also, which it will be more important. And you can also write it. It's a little bit longer though. Tell me when you can see my Excel. Can you see this Excel?
Yes, sir, we can see.
Okay, now we are dealing with inventory. We are dealing with inventory. So on the inventory side, parent selling to subsidiary, unrealized profit on closing inventory is the one that we're going to focus on. So the realized profit is based on the opening. So even when they say eliminate unrealized profit, it means your unrealized profit will be on the closing inventory. The realized profit will be on the opening. So I will request you to write this information, the one of parent selling to subsidiary, up to here. Then it's what we're going to focus on today, or in this example. Then subsidiary selling to the parent, I think it will be next week, because I think this one it will take us the last 22 minutes. So write this information. I give you less than 2 minutes or so, and then yeah. So here I'm telling you what will affect why and how do you do it. You add, you deduct. You see, the unrealized profit will affect the face value of single financial position. You deduct. The unrealized profit will affect the face value of statement of profit and loss. You deduct. The realized profit will affect the face value of statement of profit and loss. You add it. The realized profit, the opening inventory of subs, meaning the opening inventory of subsidiary, will affect the retained earning on the statement of change in equity, which you're going to deduct it. The unrealized profit will be eliminated in the closing inventory, then calculate the profit. Then you will tell me when you are done writing. Sorry. I distracted you by pressing that thing for Teams. So far you are still following, right?
Yes.
Yes, sir.
Tell me when you are done with writing. I believe you are done. Are you not done? You still want 1 minute extra? Sibonye.
It's the right thing, sir.
Oh. Last minute, like so that you can continue. Can we continue, right?
Yes, sir.
Okay, then I'm gonna remove this sheet and then I'll put the Excel sheet that we were writing on. Of sharing. Now share the normal sheet. Share the normal sheet. Good. Now we can see the normal sheet, right? The one we were working on before that one we were writing. The one we are doing statement of profit and loss.
Yes, we can see, sir.
Okay, now we're gonna have profit before tax from the which is taken from the pre-adjustment trial balance. Profit before tax, which is for parent. How much was the profit before tax? 80, ne? It was 80,000. So we're gonna say 80 plus the one for subsidiary, which it was 60, right? Right. So remember, on the profit before tax, sales were included. So what happened to sales in normal cases? We were added, right?
Right,
You remember when we were doing the profit before tax, your sales were on plus. So now you have to less them because remember we eliminated them here. Here they're eliminated. So we have to say minus 100,000. Are we fine? Remember when we are doing the profit before tax in normal calculation, you will have sales as 100,000 added. Then you have your cost of sale, which it will be the purchases, kind of. And the cost of sale, you subtract it, right? In most cases, you say minus whatever amount, let's say 100,000. So here now we say sales, because sales normally is added, we minus it here because it's the elimination purpose. So the cost of sale is normally subtracted. Now we're gonna add it. Are we fine there?
No.
Yes,
No.
sir.
Okay, the no part, who's no? Why not fine? Let's explain further. The no one.
You said we have to subtract it and then add it.
Yes. Remember, When we calculate the profit before tax in the normal circumstances without consolidations, you will have sales of 100,000, right?
Yes.
You
Yes.
have purchases. Remember, sold, A limited sold, né?
Yes, sir.
And then B limited acquired. A Ltd.
Hello.
Yeah, and B Ltd acquired. So since this is the elimination, you are eliminating this. The 100,000 which was for sales, you have to subtract it. The cost of sale, the 100,000 which was for cost of sale, now you have to add it so that this can be nil. When you add this plus this will be 0. Because you are following this journal. You are following this journal. Remember, when we're calculating the 80,000 as a profit before tax, it took this into account somewhere, somehow.
Okay, sir.
You're happy. For example, I will say, let's say we are doing the books of A Limited here. I want to show you something a little bit faster. And then here's B Limited. TD. This 100,000 A Limited sold goods to B Limited. On the B Limited, this 100,000 will sit as cost of sale, right? But on A Limited is sitting as sales. So this one, let's say his cost of sale is 90, or let's say it's 60,000. And then, okay, let me say this is 20,000. I want you to show something. It's 20,000. And then we say sales minus cost of sales, we have a gross profit of how much? Gross profit of 80,000, né? Then we don't have anything. Let's say other expenses is nil. It's nil. Then it means our profit before tax will be how much? The profit before tax will be how much?
80,000.
80,000.
Which this 80,000 is the one for parent B Limited, ne? Okay. So now let's go to the B Limited. B Limited, his sales to other people. His sales to other people, he sold for 160. Cost of sale, which is the cost of the goods he acquired from A Limited. Because remember, this their intra-group transaction. This one. So cost of sale is 100,000. The gross profit will be how much? 60,000, ne?
1,000, yes.
And then other expenses is 0. So his profit before tax will be in what? 60,000. Okay.
Yes, yes.
So now we say our 80,000, this one plus this one, right?
Yes, sir.
Then we less this one here, it was added. We less it, this one. It was added. When we were calculating this 80,000, it was added. Okay.
Yes, sir.
And then this 60,000, when we were calculating the gross profit or the profit before tax of this 60,000, the 100,000 here, it was subtracted. So this one, which it was subtracted, now we're gonna add it back. That's why you see the 100,000, this one, it will be the one which we minus. It will be the one for sales because it was added before. That's why I can put brackets there and put sales.
Okay, sir.
It was added when we were doing our calculation here. Then the other 100,000, which it was now subtracted, now we're gonna add it back. which this one was for inventory or cost of sale. Cost of sale. Is it clear? This 100 at 100.
Yes, sir.
All right. Then are we happy with our 80 plus 60 minus 100 plus 100?
Yes, sir.
Now we proceed further. We say we're gonna minus. So we minus unrealized profit. We minus unrealized profit of the things that were not sold. Which inventory was not sold at the end of the year in the books of. Let's go back and check. There was inventory unsold. Where's my inventories? The inventory is. Do you see the inventory of B Limited? Of 30,000.
Yes.
Okay, now
Yes.
let's calculate the profit on that inventory. It means the inventory means it's not sold. As I said, unrealized profit is only on the inventory not sold. As per what you wrote before. Inventory. Unrealized profit on inventory to be based on inventory not sold. So as far as it's the inventory sitting in our books, it means it was not sold, right?
Right, sir.
Okay. So which it was how much? 30,000 in the books of B Limited. Remember, we said A is selling to B. So the unrealized profit will be in the inventory of B, not of A. Because it means B didn't manage to sell that inventory to third parties. But if he managed to sell it to the third parties, it's no longer unrealized profit. Instead, it's going to be called realized profit. I'm clear. I'm clear. Here is the statement. If inventory was not sold, we will have unrealized profit, which need to be eliminated. Because they told us that A Limited made all sales to B Limited. So it means this 30,000, it comes from the inventory which was purchased from A. But A didn't sell it all. He left with 30,000. So the 30,000, they must calculate the profit on it. So now we're gonna say the unrealized profit on inventory to be based on the inventory not sold, which is 30,000. So the profit they said is what? At cost plus 25%. Ne?
Yes, sir.
Now we're gonna say the 30,000 multiplied by 25 because they say it's cost plus. Remember, the cost will be at 100%. So divide by 125 in order to get the profit. The reason here we are calculating the profit. So the profit will be, let's do our calculation. Multiply by 25 divided by 125. It will be 6,000. So this 6,000 represent the profit which was not realized. Mr. B Limited didn't make this profit yet because he didn't sell the inventory. So now let's calculate the realized profit. Realized profit. The realized profit will come as a result of the sales made the inventory on B Limited financial records amount to 20,000 on 1 January. So the realized profit comes on the inventory sold to other third parties. So the realized profit is on inventory sold to third parties. So now let's calculate something. They tell us this guy had opening inventory of 20,000 is what they are telling us for B Limited. So we're going to say on B Limited, opening inventory is how much? Is 20,000 as per information we get. So how much will it be the purchases? They told us that A Limited total sales to B Limited during the year amount 100,000. So it means purchases, as you see, like I did it here, purchases will be 100,000. 100,000. Then the closed inventory. So when we add these two together, they give us 120. So the inventory sold to public, it will be balancing figure. Inventory sold to public. And then the closed inventory is as given is how much? 30,000. So it means 120 minus 30, that balance of is 90,000. Yes. The 90,000 was sold to the public during the year. So this is a part of a realized profit, which this 90,000 take into account the 20,000, because this 20,000 was the inventory at the beginning. So if it was inventory in the beginning, now it's going to be realized. So whatever on the 100,000 that was purchased, only 20,000 was only 30